Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk to you about Digital Turbine. Digital Turbine is a stock that's one of my favorite stocks, and I believe that it has been unjustifiably punished. And part of the reason for that is that it's just been too acquisitive, and this has kind of obfuscated the results somewhat. So its revenue growth rates are very explosive right now, but investors are kind of okay. It's not going to be that explosive going forward. And it's difficult to get a sense of what a sustainable revenue growth rates are. But I'm going to go through and highlight to you why I believe that this investment is particularly cheap. Now, here's the thing to keep in mind: without just think about the scale of this business, right? So Digital Turbine is already in 750 million devices globally. So even if you may not be very familiar with the business overall, you just know the stock, you've kind of heard people mention this and that, think about that. 750 million devices and growing monthly, okay? And I'm going to highlight to you why paying 33 times free cash flow for this business is really, really cheap. Now, one of the things I wanted to highlight is that the business has been very acquisitive, and this has led to an explosion on its revenue growth rate. So you can see here the graphs, they're all kind of up and to the right. I mean, this is just beautiful graphs to see. And part of the reason has been that they just had to, they've acquired three businesses, and those acquisitions have really made the Digital Turbine much bigger. But that has come with the trade-off that investors can now kind of like, okay, what are the sustainable revenue growth rates going to be like going forward? And so on the back of the Q1 22, so just to remind you that the fiscal year and calendar year misaligned. So I'm only talking about here the fiscal year, okay? So for fiscal year Q1 22, which is the previous quarter, its organic growth rates were only 63% year over year up. So management says, okay, don't expect us to be growing at 60%. It's not sustainable, but we believe that we have what it takes to grow at somewhere between 25 to 30% CAGR over the next 3 to 5 years. So those are the figures to think about: 25 to 30% business, 30% CAGR business. Okay. Now, as I already noted, okay, so there's the two parts of the business. Okay, so they're already in a lot of devices as I talked about. Okay, but what they're trying to do is move beyond the pre-installed business. So what the pre-installed business is that it's when the Digital Turbine just gets some of that revenue when a new user opens the new phone and installs the new opens the new device, moving beyond just getting that day one activation. So how do they start to get some of the revenue dollars over the lifetime of the phone? This is what they're trying to do. Okay, so they're growing so substantially. So they're already in 750 million devices globally, and they're growing by more than 60 million every 90 days. Now think about that. That's really like huge reach, right? And so what they're trying to do, as already discussed, is how to go beyond just day one. New user opens the phone, activates the phone, those they get certain number of apps installed already, and that those apps have to pay Digital Turbine to be on the phone. How do they go beyond that? So that's somewhere they're trying to compete with Iron Source. Iron Source is a business that is Thomas Bravo backed, and Iron Source has this one segment they call Aura, which is helping telcos participate in the app economy. So this is where Digital Turbine is going to be up against. So that specific segment. The only difference being that Iron Source is much more focused on games, whereas Digital Turbine is broader. It's not specifically focused on games. Now, for telecoms and original equipment manufacturers, OEMs, for them, kind of being able to get some of those marketing dollars, they've been left out by the likes of Alphabet and Meta, and they kind of see, okay, the user is going to open up their phone, they're going to do something, they know what the user is going to do before anyone else does, before the person checks on social media or whatever, they know what they're going to do, but they're being priced out of that high margin business. So they're trying to get some of that marketing dollars, some of that influence. They're trying to get some of that, a piece of that pie. And as I already described, when Digital Turbine has so much scale that they're already on 750 million devices globally, and they're fully independent, it's a good partner to come against. So when Digital Turbine gets paid its revenue, it has to split off a portion of that to telecoms or OEMs. So that's why the gross margin of the business is quite low, because it has to split off some of that revenue as a cost, right? But it's still, when everything is said and done, it's a very strong free cash flow generating business. But I'll come to that in a second, right? So one of the things I want to highlight is that the way it works is that, let's say you open your phone and you have Lyft installed on your phone, you're much more likely to order a Lyft than you are to order an Uber if Lyft is already there. It's already on your phone. You're like, it's seamless, right? And that simplicity, getting that customer adoption, is very much worthwhile paying up for. And that's something that Digital Turbine excels at. Now, as I already discussed, so to get some of that revenue, it has to split the cost with either Verizon or Samsung or whatever. So that's why the margins of the business are not that high compared to something else. Some of those quote unquote high margin but yet unprofitable businesses that everyone's like paying really high multiples for. That's not here what's happening with Digital Turbine. It's a low margin, a low gross margin, but high free cash flow generating business. Now, a lot of people said, okay, what's going to happen when the changes with iOS, with Apple and everything. So here they highlight, okay, so the amount that Facebook is spending on Android is just going higher, and it's really moving dollars away from iOS, where they kind of not being able to get past those privacy changes, and it's going to Android. So it's just basically because brands are just pivoting, or app developers are just pivoting a lot of their marketing spend away from iOS to go towards where they actually get a high return on investment, which is Android. So as I already discussed, what Digital Turbine is trying to do is move beyond just at day one. So on the back of their free acquisitions, they're trying to get more of that lifetime of the revenue from the phone. So not just day one, but over time. So one product that they've done particularly well is SingleTap. SingleTap is where you're kind of, let's say, shopping or you're playing a game, and this kind of banner comes down, and if you click that banner, it installs an app without you having to exit that immersive experience that the user is in right now. So everything happens in the background, and um, and that's really something that's very, very attractive, because it removes some of the friction of having to go away to, let's say, the Google App Store. And that is revenue stream on SingleTap is up 600% year over year, and now accounts for approximately 8 to 9% of Digital Turbine's total revenues. So it's something that's very, very interesting. And as I already described several times, the business is very doesn't have a lot of capex requirements. They have a lot of the revenue has to be split off and goes to, let's say, the OEMs or telecoms, but it doesn't have a lot of capex. So everything that boils down to cash flow from operations ends up as free cash flow. It's a very free cash flow generating business. And just to highlight, so the free cash flow was up 85% year over year for Q2 2022. So you can see that this is a business that is able to, as it grows a little bit on the top line, is really able to grow very, very fast its bottom line free cash flow. And they're targeting their free cash flow, their EBITDA, to go from just 100 million for pro forma fiscal 21 to, over the next 3 to 5 years, to more than a billion. So it's really going to expand by about 10x. Now, one of the things I want to highlight, you're already seeing this to a certain extent take place. So for Q2 2022, EBITDA was up 190% year over year. So they're showing that they're backing up with the narrative with the financial statements. Now, here's the thing that I want you to know, that the business, if you look at it right now, okay, so if we take the guidance for Q3 2022, they're pointing at approximately 355 million of in revenues. Now, the consensus is approximately for 1.2 billion for this year's revenues. So this puts the stock trading at 4 times free cash flow for this fiscal year right now. Now, if we make the assumption that the free cash flow margin stays around 13%, this would mean that by the end of this year, Digital Turbine would make 150 million of free cash flow. Now, that would put the stock right now trading at 33 times free cash flow, this year's free cash flow. Now, This doesn't give any, pretty much no consideration for the fact that they're guiding investors that over the next 3 to 5 years, let's say, even 3 years, they're going to jump their EBITDA line from zero point 0.5 million, for 0.1 billion to approximately zero point 0.3 or zero point 0.5 billion of EBITDA. So you're going to see a dramatic growth on the bottom line in EBITDA, and investors are not having to price that in at all. So, when it boils down to it, it's really about um, how to get some of those marketing dollars for telecoms, how to get them take a piece of those very high margin advertising dollars. And for this, they can partner up with someone like Digital Turbine that obviously has a lot of scale already. They're already in countless devices, and it's obviously generating a lot of free cash flow and it's growing. So any investors are not paying a lot for it. So that's the one stock that I'm particularly bullish right now. So obviously I'm a bias there because I'm already invested here. But if you want to find out other names that I'm particularly bullish about right now, don't forget to check out my marketplace. It's called Deep Value Returns, where I help you become a better investor, help you think about high quality, actionable investment insights. Okay. Thank you so much for listening. Have a great 2022. See you soon.